All right. Good afternoon and welcome to another episode of Business Spotlight. I'm here with Arthur Psaltis, and we're going to be looking at the M&A industry, corporate advisory space, which I'm quite excited about. Welcome, Arthur.
Hi, Stephen. Good to meet you.
Good to meet you. Tell us a bit about your business, the one that you've got at the moment.
VMG is a business that focuses on assisting medium-sized companies through the challenges they face across their businesses, mainly focused on corporate financial issues, structures that the companies are grappling with access to capital, simply. But as we talk to all our clients, it's always about how they present to the capital markets, and their underlying business foundations need to be strong to be able to attract the lowest cost of capital. And so that's what we're about, is to improve the efficiency of the systems, processes, and the access, the way they access the market, whether that be on the sales side or on the cost side. We're about finding improvements for the business and introducing our clients to new ways to access capital.
Excellent. And what's that space like now at the moment? I know it's probably changed a bit over the last 18 months.
Yeah, look, there'll be no prizes for guessing that the mainstream banks in the SME market have the credit is tight, and interest rates are rising, and so we're typically seeing a lot of our clients accessing into the non-bank financial markets, where there is a very big discrepancy between what the mainstream banks will charge as interest rates and what the non-banks will charge at interest rates. We're talking low teens as the very lowest. And then you've got to be very careful about the effective interest rates that the non-banks are charging. So their headline rates might be 14%, but if you actually do the analysis, the cost is more like 30%. And if you're on margins of 20%, profit margins of net profit margins of 10%, say, it's very hard to make money when you're being charged 30% interest rates.
Absolutely.
So we're seeing there's a big discrepancy there, but there's let's say there's more funds available in the non-bank financial markets. So that's where people naturally gravitate. So it's about trying to find the most efficient for medium-sized companies. What is the best form of capital that they can access. In the equity markets, there's been a shakeout what we're seeing is a shakeout and a lowering of confidence in the application of funds into medium-sized scale-ups, not to mention startups. Startups would be having even harder times in this last 9-month period. But even in the scale-ups, we're finding it's people making the investment decision is becoming more difficult as the uncertainty in the inflation and interest rate markets play out.
And what's your ideal kind of customer, and when do they come and seek your services?
Well, the ideal customer really is, we are looking for growing businesses. We're looking for businesses with 20 employees to $10 million worth of turnover type number, and they are expanding and are looking for ways, or the most efficient way to be able to do that. And it always involves money. So structuring finance is a key part of it. where we're advising across a range of industries: manufacturing, wholesaling, importing, real estate, technology. So there's a a good diversification of different industry groups that we focus on. They'd be family owned. Typically, that we're seeing where the need arises is that the owners are so embroiled in the business that they just haven't got time to step back and look at the issues that they could or the challenges that they could resolve, because they're just so deep in the business on a day-to-day basis, 7 days a week. So we're all about trying to free up those people. We've got a medical supplies company that's growing at 50% every 6 months, and that presents a significant problem as to how to fund that type of a business. Others are in the importing space. We've got significant challenges in the freight markets, uncertainty and price volatility, and time frame restrictions, and then there's the foreign exchange rate risk profiles. So we're seeing a range of different issues, and the types of clients that are emerging are those that are prepared to confront the problems and see if they can do a better job.
Okay.
In fact, what we do is we run a diagnostic, and the diagnostic really pinpoints where the issues are. And the diagnostic helps the client because the client understands where their challenges are. And it helps us because if the client's not prepared to meet the challenges, then no one's wasting anybody's time.
It's a lot of familiarity there, even
yes.
at the lower end of the scale. So Arthur, your own entrepreneurial journey, tell us a bit about that. Have you always been a business owner, or did you make a switch from something?
No. So my background, I qualified in the world of chartered accounting with PwC way back when it was Coopers and Lybrand. Spent many years with them in an international role. We spent 4 years in Europe, based in London. Then I came back to Australia and started in the it went into the banking world. So with Macquarie Bank, in a corporate advisory role. So not let's say a traditional banking, that was more in the investment banking role, and then left Macquarie to go to Westpac, and then followed by NAB to help them create their corporate advisory businesses in their wholesale banks. And spent about 12 years working on strategies to build, let's call it the value add product, where the trading banks were actually earning, let's call it, they're getting value for their intellectual capital rather than pushing money out the door and earning interest rate margins. It was all about trying to be value add to the customer base. So that was working in the trading banks, gave me a lot of insight into the financial limitations of the Australian market, and it's a very immature. When you compare it to, say, a European or a North American market, it's a very immature market and very shallow market.
Right.
As a result, there's a lot of arbitrage goes on in pricing of risk, and that's just how it plays out. As the population gets bigger, that improves. But ask anybody about the efficiency of the private debt markets in Australia, and it doesn't have any comparison to, say, North America or Europe.
And so what was the catalyst to go from that into your own business?
Well, having finished the delivering a strategy at NAB, and the final role at NAB was to focus on what they do with JB Weir, which is the classic stockbroking, probably one of the best name, in terms of brands in stockbroking. It was, let's just say, by 2010, it was a business that was not like what it was back in the 80s. And the focus of the strategy there was to reinvest into that brand and offer corporate advisory services to middle Australia, companies less than $100 million worth of turnover, which was an area for NAB that has the market share up over 40% of that market. So it's a natural place for NAB to play. And the research that we undertook showed that it's a heavily underinvested market in terms of people providing services. Firms are providing services to small businesses was, let's say, underinvested and underdeveloped. And so it was a natural focus for a bank like NAB. Cutting a long story short, NAB chose not to do it. And after a number of years, I decided that with the need in the market for corporate advice into the mid-sized companies, there's an altruistic element to this. Mid-sized companies need help, and we're trying to reach out to those companies to find solutions for them. So that's how we morphed into owning our own businesses, seeing the need in the market and trying to plug that need.
Yeah, nice. And making that switch, and since you started to now, what's been some of the challenges in going?
Well, it's all the challenges our clients face. Interestingly, Stephen, the biggest issue for us is how fast we grow and how many people we put on. And we're not trying to become a major consultancy because that requires a lot of people. So we're at a point where we've got 2 directors in the business, and some let's say less senior personnel, but we don't want to grow beyond the 2 directors, because it's a case of we're trying to sell our experience over 30 years, each of us, and it's our values, it's our track record, and it's our knowledge that we're trying to work and impart in the market, and so we're at the difficult stage in an inflection point where do you grow and bring on more people, or do you just deal with the what you can as a small consultancy? And that's a real problem. That's a struggle for us, because as we take on more clients, it's less hard to, it's not as easy to servicing those clients. So then it's a catch-22. You have to bring on more people, and then you have the issue of scaling up and getting bigger. But we're quite happy providing our services to a niche group, small group of clients, and provide direct service to those people. So we're not, you don't sign up with VMG by talking to me and then suddenly someone else turns up to do the work. It's what you see is what you get. Now that has its challenges, because you can't grow by numbers, by personnel, but it makes the work a hell of a lot more interesting and a lot more gratifying, because you're making changes real time, and you're seeing it happen from your own experience, and not through the large firm type approach. Anyway, that's today's conclusion. Tomorrow might be a different one. We may need to we may need to bring on. Certainly, we will have to bring on more arms and legs. It's just how many, whether we can grow the business and keep our values and keep true to our our philosophy is where the challenge is.
It's almost a case of life imitating art there. You're advising your clients to grow and you're making a decision whether or not you stay the same.
Yeah, it is. It's we should run the VMG diagnostic on our own business. We probably wouldn't score very well on the strategic focus side, but anyway, that's for another day.
Yeah, and it sounds like you're deliberate about what you want out of it too. I think that's important. And growth at growth's sake isn't always the
yeah. Look, we could grow it and merge with another firm, but that's not what we're thinking about. We're trying to help companies, and that's what we're trying to do. So, and it's a very personal approach.
Sounds good. So, what advice would you give to businesses that are like that sub, like maybe like 3 million to 9 million, sub your market, that, you know, as they grow, at some point, they're going to need access to capital. They're going to want to sell. When should they start preparing, and what should be the key things they focus on?
Well, interesting you asked the question, because we do have clients that are below the 10 million level. And our approach with those clients is you need to have a 5-year plan.
Mm-hmm.
It doesn't have to be war and peace, but it needs to be a plan. Where do you want to be in 5 years, and maybe even beyond that? And in understanding that, where the company wants to be, that then gives you a destination of where it doesn't have to be hard and fast, but it gives you an idea. Maybe we want to sell the business, or we want to introduce equity into the business so that we can, create a management buyout in the down the path, or we would like to grow through acquisition. It doesn't have to be a pinpoint destination, but it's good to have some big picture views on where the business needs to be. Then the next element is run the business in a disciplined way. Run the business as if you are a $50 million company. Now, that doesn't mean you have to have reams and reams of systems, processes, procedures, all those sorts of things. But there are some core disciplines that need to be adhered to, and just be disciplined about it. So, for example, have monthly management accounts, have forecasts and budgets, and review your performance to those budgets, and meet regularly, and even it's not outside of the realms of possibility for a $5 million turnover company to have a 6-monthly meeting with their accountant and say us, and treat it like a board meeting, where the owner becomes, it's all about discipline and being focused on setting goals and trying to achieve those goals. Now, no one's going to get into trouble for not achieving the goal, but it's if you don't have goals, but one thing's for sure, you're not going to succeed. So it's simple disciplines, and that's really the experience of VMG, because we come from let's call it the institutional end of global finance. We have a strong understanding of what big global listed companies require to attract low costs of capital and investors. And so with that understanding, we then try to scale it right down to small companies who can pick up on the disciplines that are required and set the standards and try to achieve those standards. And not everyone wants to do it because it's it requires discipline.
Mm.
And we want to work with people that are wanting to get fit and healthy, and that's not in a medical sense. We're talking for a company. If they want to get fit and healthy, we want to work with them.
Excellent. And just lastly, Arthur, if anyone's inspired by this, or they're in your target market, how can they get in contact with you?
Well, we're there on the website, and happy to have a no obligation conversation. As I say, we are legitimately trying to find companies that are finding it difficult in the marketplace, and at this early stage, we're a set of ears listening and trying to understand whether there's ways that they could make their life easier. So book an appointment. We've got you can book an appointment, and I can easily come onto a Zoom call or a Teams call, and we can just chew the breeze. What we've been doing in the last 2 years and through COVID is literally contacting as many CEOs and CFOs as we can, and we just ask them, "What's your experience? What are you finding out? What are your headwinds? What's going well? What's not going well?" And it's just fun to have those conversations, And sometimes those conversations turn into mandates where we help the company. But at the end of the day, we're here to try to help people solve their problems.
Fantastic. Well, thank you for your time today. That was an excellent insight into some of the mechanisms that happen at the in the mid-size. Thank you very much.
You're very welcome, Stephen. Great to meet you.